Hello, friend. If you are interested in investing in multifamily properties anywhere along the west side of Chicago, you should stick around because I'm about to go deep into the numbers on how the different areas, all the different neighborhoods within the west side of Chicago compare to each other, specifically in terms of 3 and 4 unit properties. If this is your first time meeting me, my name is Jake Lyons. I'm a real estate agent here in the Chicagoland area with Berkshire Hathaway and also the owner of the ChicagoHomeSource.com. And I love the small multifamily space. It's got what got me into real estate to begin with. I was a financial advisor before I got into this Series 7 license, the whole thing. But seeing the power of specifically the 2 to 4 unit multifamily investing really got me wanting to help people with that instead. So here we are. And the reason I like the 2 to 4 unit space so much, as I'm sure many of you might already know, but some of you might not, is because you can get a 2 to 4 unit building with the same kind of financing that you can a house, even though it is a revenue generating asset, similar to a big old high rise downtown, big apartment building, similar, machinations happening there, but you get to, get a FHA loan or a VA loan or a conventional loan rather than having to get a commercial loan. So in this video where I'm just focusing in on the west side, I have other videos that talk about, northwest side, north side, south side, far south side, and etc. But this one is on the west side. So let's dive in a little bit on what I am considering to be the west side of Chicago. Okay, the west side is relatively small compared to some of the other sides of town that I deal with or that I've gone over. This is a map of all of Chicago. This is all 77 neighborhoods or 77 community areas that comprise the city of Chicago. You might have heard the 77 neighborhoods, but there's really more like a couple hundred neighborhoods in Chicago, but they all kind of fall within the confines of these various 77 community areas. Like, for example, just sticking with like the near west side, like some of the neighborhoods within the near west side that you might have heard of is Tri-Taylor. The West Loop is actually in there. It's not listed here, but University Village, the Medical District, Greektown. These are all pretty popular, famous areas that are talked about a lot. Nobody says near west side, right? But that's what we're talking about here. So the rest of the north side, as it's being defined here in this for this analysis, near west side, West Town, which has Wicker Park, Ukrainian Village, Noble Square, parts of Humboldt Park. Humboldt Park is also its own area over here, also west side. East Garfield Park. You'll never guess what's next to East Garfield Park. If you guessed West Garfield Park, you just won a prize. West Garfield Park over here. Austin, which by landmass is actually the biggest area in the city. And then the Lower West Side is the other one. So Pilsen and Heart of Chicago are some popular, pretty well-known up-and-coming areas in the Lower West Side. And then, South Lawndale, I believe, is I'm considering that as a south side or maybe a southwest side. I can't remember which one. But anyway, so that is that's the west side, at least as it is being defined in this analysis here. So let's get into some numbers then. Okay, I was wrong. North Lawndale is a part of this analysis for the west side. So my apologies to all the North Lawndale people out there who consider themselves west side and felt shunned in that last segment. So here we are. The first number that we're getting into here is the average sold price per number of units for the building per neighborhood. Okay, so the neighborhoods, we're gonna follow this kind of same format in all of them. The neighborhoods are listed down here, and then the blue columns or the average sold price for 3-unit buildings sold in that area within the past year. So as of about midway through 2021, going back to midway through 2020, that 12-month period is what this data is based on. So, based judging on whenever you're actually watching this video, safe to say the numbers have probably shifted at least a little bit, but as the case I think is going to be the case for all of these, depending on just, if you're watching this like 2 years from now, it'll probably be pretty different. But if it's only a few months or something, it's probably we're in the ballpark of what it is most likely. Okay. So yes, the average sold price of 3-unit properties and 4-unit properties. 4-unit properties being represented by the red columns. Okay. And what you see here, so West Garfield Park and the near west side just they just didn't have enough 4-unit properties to even really make any calculations based on. But surprisingly, I think what you see here is you would expect the cost of 4-unit properties, at least I would. And I talk about this in all my videos. I'm starting to sound like a broken record if you've watched some of the other ones, but it's true all across the board. You would expect the price of a 4-unit building to be significantly higher than the cost of a 3-unit building, because you are bringing in a whole nother stream of income. But that's really just not what you see. What you see is, if anything, like Lower West Side, like the Pilsen area, it's basically the same. Same for 3 units and 4 units. Lawndale is just like a little bit more. Humboldt Park is just like a shade, between for a little over 400,000 for a 3-unit, and then about 500,000 for a 4-unit, which that actually is a pretty good jump. But still, even still, that jump I think is probably less than the more income that you're bringing in with that extra stream of income. And then East Garfield Park, is actually 3 units are actually more there, so on and so forth. So, so that's kind of interesting. We'll see the how that affects the actual sort of ROI metrics and how it affects things from an investment perspective here in a couple more graphs. But for now, just this is kind of the entry points for the various neighborhoods. Money talks. Supply and demand is what it is. That for without getting into different reasons for why things are cheaper in some areas versus more expensive in others. I like to just let the numbers do the talking for me. So the near west side, that was over by the West Loop and that kind of area, over by by where the United Center is, where the Bulls and Hawks play and that kind of thing. Kind of over that way is the most expensive. Probably this is the most, it's closest to downtown. So just proximity to downtown is always going to come at a premium a little bit. 3-unit properties there, you're going to be spending almost 700,000 to get into a 3-unit property there. Lower West Side, Pilsen has been growing like a weed over the last several years, which I'm sure we'll see here in a few graphs from now what exactly that looks like. But in either case, you're coming up a little just shy of 600,000. And then on the low end, you're looking at like North Lawndale, Austin, some places like that. Humboldt Park is kind of in the middle. Humboldt Park has had some pretty nice growth. Still, definitely developing, and etc. So this is pretty much what we're looking at in terms of the average sales price per unit per neighborhood. If anytime, feel free to pause if you want to take it in. But other than that, going to move on to analyze the different rents for the different neighborhoods. Okay, we know now approximately, at least on average, how much it would cost to get into one of these buildings for the 3-unit or the 4-unit. I don't go into 2-unit buildings just because it's just not the, I think there is definitely a time and a place for a 2-unit building, especially for owner occupant situations and things like that. All of these work really well for owner occupied situations. But I just focus on 3 and 4 unit buildings because, in my opinion, that's just where you're just getting the most bang for your buck. 2 unit properties, a lot has to go really right for you to even really break even, or especially to make a profit on it, if that's what you're trying to do. So at 3 units, in my experience, that's where I start that's where I start seeing um, the whole process of actually buying one of these types of buildings actually really paying off. So that's why I focus on that. Although, of course, everything's case by case, right? Property by property, case by case. Anyway, we're not talking about that anymore. We're talking about rents. So now that we know how much it is to get into one of these buildings, here's what you can expect on average to see for the various rents in the different neighborhoods. So all the blue columns you see is the average expected rent for 1-bed units. The red is for 2-bed units. The yellow is for 3-bedroom units. The green is for 4-bedroom units. And then the orange there at the far right of each neighborhood is just the average overall rents for that neighborhood. So just everything that rented, just throw it in a big bucket, take the average of that. That's what that number is. So, you see the pattern that you would kind of expect to see. Obviously, 4 beds are more than 3 beds, 3 beds more than 2, etc. I don't have any data on it, at least in this graph for studios. I can pull that up if you really want me to. Just hit me up after. But yeah, so it follows that pattern that you would definitely expect to see. Well, a little bit, except for the near west side. That's kind of weird. That's the first time I've actually seen that, where the 3 beds come out to look a little bit more than 4 beds. That's interesting. But yeah, and so it follows that pattern that you would expect. It also follows the pattern of the areas that cost less to buy in, also cost a little less to rent in. Vice versa, near west side, that was the most expensive one to buy in, also the most expensive one to rent in. Average here is the average overall rent anywhere in the near west side, you're looking at, what's that, like $2,400 per month. And then the lowest is actually Humboldt Park, which is, coming in at like right about $1,000 for the average in Humboldt Park. Which is interesting because you see all of these, so there must have been a lot of lower end properties kind of bringing that one down, and opposite for Austin. So yeah, there's kind of some interesting behavior going on in Austin and Humboldt Park in terms of that. But a important thing to keep in mind in these later measurements and later metrics as I start analyzing some different things is that it's all taking, the only number I'm taking as far as like the revenue goes into consideration is the average overall rent. The reason for that is, if I started to say, if you bought a 3-unit property that had all 4 beds, or different distributions, like a 4-bed, a 2-bed, and a 1-bed versus a 3-bed, it starts getting just insane. And this would be a 3-hour video. So just for the sake of these purposes, just for the sake of like a 10,000 foot overview and consistent analytics across the board and that kind of thing, all I'm doing is taking the average overall rents for that area. And this is all taken from MLS and other third-party listings like that, or third-party sources. I think that's all you need to know for this. Again, go ahead and pause it if you want to take a look at it some more. But from here, we're moving on to a metric we call the 1% rule. The 1% rule, more like the 1% guideline or the 1% just quotient, whatever. If you have spent any time on Bigger Pockets, listening to the Bigger Pockets podcast, maybe going to the website in the forums and reading blog posts or anything like that, you have probably at least heard of the 1% rule. Bigger Pockets, of course, is I think it's the world's largest real estate investing community, at least online. It is free. If you've never heard of it and you are interested in real estate investing, as if you're still watching this, surely you are, highly recommend you watch this video, watch all my other videos, and then go check out biggerpockets.com because it's fantastic. I got nothing bad to say about them. The 1% rule, essentially, what this does is it takes the gross monthly rents that your building is generating and divides it by the fair market value, or for, in our case, taking the average rent times the amount of units that we're talking about divided by the cost for the building of whatever unit number we're talking about. So like the average rent times 3 divided by a 3 unit building is and then coming out with that. So if there's a $100,000 building and you're getting $1,000 of rent per month, there it is. That's your 1% right there. 1%, I think a few years back when BiggerPockets kind of coined and or popularized this phrase was, I think a lot of investors back then kind of saw this as like, if the rent is at least 1% of the price, that's kind of like their one metric for whether they consider that a good deal, a good investment or not. Obviously, there are a ton more variables than that. There might be you might be getting 3% on it, but maybe the vacancy rate or the turnover in the area is a lot more, or there's more renovation costs. There's all kinds of things. So this is not by any means the only thing that matters, but it is one good way to compare different properties in different neighborhoods and things like that. So this is what we're looking at here for how these West Side neighborhoods compare to each other. You see a lot of them do cross that 1% for whatever it's worth. And you also see, you start seeing a little bit of what I was talking about earlier of how just the more units, the better. Like here in East Garfield Park, 4 units are way more than the 3 unit. You're almost at like 1.7 or something here versus pretty much right at 1. So just adding that extra unit almost doubles, not quite, but might as well, essentially the bang for the buck, at least according to this metric. Humboldt Park is pretty close, North Lawndale is pretty close, but it's all more for sure. And then you can just kind of take a look and see like how the other neighborhoods compare and what they were showing out to be. So don't need to spend a whole lot of time on this, but I do like the 1% rule just as another means of comparison. So I'm going to move on now to something that you might be a little bit more familiar with, which is cap rates. If you've been interested in real estate investing for any length of time, you have probably heard somebody refer to a building as a 6 cap or a 10 cap, or I sold my underperforming 2 cap or something along those lines. This is the metric that they're talking about when they say that. So what cap rate is referring to is the annual net operating income divided again by the fair market value of that property. So it's a little different than what we just talked about, which was the gross monthly income. This is the annual net operating income. So the annual gross minus all the expenses, and then divide that by the by the fair market value. So, and also for our purposes here, the fair market value being just the average sales price. And to determine the expenses, I had to get a little creative. This graph is a little bit more art than science. I basically just took some average expenses that I see out in the real world and applied it to this. So things like 8% vacancy rate, approximately on average what I see a lot of investors using and what I see shaking out to be the case in the real world. Turnover about a month or so to turn over between tenants and things like that. 8% management fee, that's about average. 10% combined in saving for maintenance and capital expenditures. That's like going to vary a lot depending on the area and the property, of course. And things like, 1.5% for property taxes, and, insurance and utilities and things like that. So, this is going to be highly variable, not perfect, but it's at least consistent across the board, and I believe at least a worthwhile metric to again, just for comparison's sake. So with that all being said, how we see this shaking out in these different neighborhoods, you see Austin and East Garfield Park having really good cap rates for the 4-unit properties, up to 14%. And again, that doesn't necessarily mean that it's if you're buying a 15 cap, that doesn't necessarily mean it's a home run, or that it's gonna that you're not gonna have to work hard for it, and there's not gonna be some other things that come with it. But just speaking just strictly on numbers, it also doesn't also me saying that doesn't mean that there are going to be those things. Don't misconstrue what I'm trying to say there. So Humboldt Park is the lowest cap rate, at least according to how I ran these numbers. A little bit lower, a little bit below 5% in both cases. But for the most part, the west side is getting between 5 and 10% is kind of what I'd say the expected cap rate values could be considered there. So if you have any questions or want to dig deeper into these things, definitely reach out. Otherwise, I'm going to go ahead and move on to some more long-term metrics that we should be paying attention to as well. Everything we've talked about so far is really just kind of like here and now stats. The how much does it take now to get into a place? What are the rents that these areas are getting now? What kind of cash flow, what kind of ROI could I expect to see now? What kind of income could I expect to see now? These are all very important metrics to consider, and should be probably the first ones. I mean, you want to make money every month. You certainly don't want to lose money every month. Obviously, you're not going to be holding on to this property very long if you're losing money. But once that part is figured out and is stabilized, and you have a good well-running asset from that point of view, the next thing that you definitely want to take into consideration is the appreciation rates in the areas that in the area that you're buying in. So, that way, that's what, the stuff that we've been talking about adds to your income. Appreciation is what adds to your wealth and your net worth and your, the equity that you're building in these assets that you own. So, like that way, when you look back in like 5, 10, 15, 20 years from now, and you say like, wow, this place is worth so much more than what I bought for it. And now you have all these options. You can cash out, refinance. You can get a relock. You can get a HELOC. I mean, you can sell it at a huge profit, whatever you want to do. You have those kinds of options. So that's why, appreciation rate is obviously a very, very important thing to consider. And this is what we're looking at here. So the blue columns that we're seeing here are the average annual appreciation rates over the past 5 years. And then the red is the appreciation that we've seen in just the past year. So interestingly, on the west side, this is the first I've seen this. The past year has actually underperformed what the past 5 years have done, except in all cases, except for Humboldt Park and to a lesser extent East Garfield Park. West Garfield Park is just bonkers over there. I mean, man, look at that. The last 5 years has averaged 55% growth per year. Now, that doesn't necessarily mean that if you buy a property, like if you buy an already well renovated property in West Garfield Park, that property is automatically going to increase by 50% year over year. What that does mean, though, is that that's just an indication of the type of investment and renovations and this development that has been going on in that area. So like, for like Lawndale, North Lawndale, Garfield Park areas, certain areas like, places where you could, several years ago, you could pick up a building for $5 and a signature. Now you're seeing that, once you fix that up, now you're seeing that those places are going for hundreds of thousands of dollars, and now it's kind of lifting the tide of the whole area. And so that's just what you're seeing there. So think of these as indications of just what's going on a broader scale in the neighborhood, rather than necessarily what's going to happen to individual properties. Although certainly, this is a good indication of the type of growth that individual properties could/should have. Maybe not 50%, but there should be some growth there, you would think. No crystal balls. I'm never gonna absolutely exclaim that I know what's gonna happen in the future. If the last year, 2020 and all that has taught us anything, is that nobody knows anything of what's gonna happen in the future. But the past is the best indication of the future, and this is what we're looking at here. So take that for what you will. The near west side, lower west side, these areas are coming in. Well, pretty much all of them. I mean, yeah, even this, like like 20% almost for all of these. The lowest one being Humboldt Park, and that's even like 12-15% year over year over the past 5 years. So this is a massive growth. You compare this to I just did a video on the north side, where all the north side neighborhoods are crawling along at 1 to 5% appreciation. And that's not to say one is better than the other or a better investment. It all depends on your individual goals and where you want to be, and all kinds of things. But as far as just a straight appreciation play, man, these doesn't get a whole lot more gaudy than these numbers here. So leave this here, and this is the last of the graphs that I'm going to discuss. And let me know if you have any questions on this. That is it for my discussion on multifamily properties on the west side of Chicago. I hope you got something out of this. I hope this was very helpful and beneficial. And if those things are the case, I hope that you like and comment and subscribe and share it with a friend and somebody else that you think might benefit from this as well. Please just do the thing that indicates that you like this and want some more of it. If you, again, my name is Jake Lyons. I'm a realtor here in Chicago with Berkshire Hathaway, and I have a lot more resources than just this one. I have videos similar to this on the north side, northwest side, south side, far south side. Obviously, this one was the west side. I also have a whole meta-analysis where I compare all those different areas to each other, like averages of averages of averages. Is kind of some crazy, inception analysis stuff going on there, but I think it's pretty helpful if you're just getting into it. And I think the best thing that I have going right now is actually the daily newsletter that I have that goes out and analyzes each 3 and 4 unit property that comes out in Chicago, that comes to the market in Chicago, and analyzes each one by hand in terms of potential rents and cap rates and the price that it's getting and all kinds of things like that. So if you are really serious about getting into the small multifamily investing game, I don't think there's a better resource out there than that. So that's all I got for this one, and hope you got something out of it, and look forward to seeing you again. Thanks.